Do you want to know how to save thousands in stamp duty without buying the property? So imagine acquiring £1 million property portfolio and instead paying stamp duty land tax based on the value of the properties, paying just 0.5% stamp duty on the transfer of the shares. Sounds unbelievable, right? But for the right transaction, it can be a legitimate acquisition strategy. And over the past few months, I've been involved in an increasing number of property transactions where clients aren't buying the bricks and mortar in a traditional way. Instead, they're purchasing the limited company that owns the properties, okay? And these are known as a share purchase transaction, and it's documented for a share purchase agreement, also known as an SPA. So they're becoming increasingly common amongst experienced investors, developers, and portfolio landlords, but they're also one of the most misunderstood areas of property acquisition. And when they're structured correctly, they can provide significant commercial and tax advantages. When they're structured incorrectly, okay, they can expose a buyer to substantial financial and legal risk. So in this video, I'm going to explain what a share purchase agreement actually is, okay, why investors use them, where the stamp duty or the potential stamp duty savings come from, the risks that every buyer needs to understand, how lenders view these transactions, and when a share purchase could be the right strategy for your next acquisition. Before I get into this, one important disclaimer. I'm a commercial finance broker, not a solicitor or a tax advisor. And every share purchase transaction should involve experienced legal advisors, qualified tax professionals, as every deal is different and tax treatments depend entirely on your own circumstances. Now let's get into it. So what is a share purchase agreement? So normally, okay, when you buy an investment property, the legal title transfers from the seller to the buyer. But a share purchase works a little bit differently. So instead of buying the property itself, you're buying the shares in the company that owns the property, okay? And the company then remains exactly the same legal entity. Its bank accounts remain the same, its tenancy agreement remains in place, its leases remain in place, its contracts remain in place, its property titles remain registered in the company's name, okay? But the only thing that changes is who owns that company. And that ownership transfers for a legal document called a share purchase agreement, often referred to as an SPA. This agreement sets out every aspect of the transaction, including the purchase price, completion arrangement, warranties provided by the seller, indemnities protecting the buyer, and disclosure of any known issues and each party's legal responsibility. It is far more detailed document than a standard property purchase because you're acquiring an entire business entity, not simply a building. So why are investors doing this? The biggest reason people talk about share purchase is tax. When you purchase residential property in England through a traditional acquisition, you normally pay stamp duty land tax based on the purchase price, okay? But depending on the value of the asset, this can represent a very significant cost. However, if you're purchasing the shares in a UK limited company, the transaction may instead be subject to a 0.5% stamp duty on the transfer of those shares, rather than stamp duty land tax on the underlying properties. And that difference, okay, can be substantial on larger portfolio acquisitions. I want to stress something here. This isn't a loophole, okay? It's a workaround. It is an established method of acquiring companies. However, whether it's appropriate depends entirely on the transaction and the advice given by your solicitor and tax advisor. Tax legislation is complex, okay, and every acquisition needs specialist advice before proceeding. But there's the catch, okay? One of the biggest misconceptions is that you're only buying the properties. You're not. You're buying everything that sits within inside that company. The property, tenancy agreement, leases, service contracts, supplier relationship, historical accounting records, every tax obligation and every contingent liability, every unresolved dispute, every legal responsibility attached to that company, okay? If the company has unpaid tax issues, you inherit it, okay? If it has historic litigation, you inherit that. If it has hidden liabilities, potentially you inherit those too. That's why due diligence is absolutely critical when you acquire businesses. In many ways, okay, buying a company requires more investigation than buying the property itself. Due diligence is everything. So before proceeding, buyers will often instruct specialist solicitors, accountants, tax advisors to undertake comprehensive due diligence. And this may include reviewing statutory accounts, corporate tax returns, VAT, company's house filings, loan agreements, charges, employment matters, leases, tenancies, planning documentation, service contracts, ongoing litigation. And the purpose is simple, okay? To make sure there are no hidden surprises after completion. The SPA itself also provides protection through warranties and indemnities, giving buyers legal recourse if information has been withheld or misrepresented. So how do lenders view share purchases? This is probably one of the most common questions I get asked. But the good news, okay, is that many specialist lenders are comfortable funding share purchase transactions. However, they're not treated as straightforward property purchases. Lenders typically carry out enhanced due diligence. They'll still value the underlying properties, they'll still assess rental income, and they'll still review borrower affordability and experience. But they also want to understand this: company structure, acquisition rationale, legal advice being provided, and how the risks are being managed. And this is where having an experienced commercial finance broker becomes incredibly important. Every lender has different appetite. Some won't entertain share purchase at all, others actively support them. Knowing where to place the transaction could save weeks of unnecessary delays. So when does a share purchase make the most sense? In my experience, share purchases are particularly attractive when acquiring larger residential portfolios, commercial investment portfolios, SPVs, mixed-use investment companies, or businesses where retaining existing leases, tenants, and operational continuity creates additional value, okay? And they're particularly effective where the underlying company is well managed, professionally operated, and supported by strong legal and financial documents. Share purchase agreements aren't suitable for every deal, okay? But for the right acquisition, they can be an incredibly powerful tool. Potential stamp duty saving, operational continuity, simplified portfolio transfers, and in many cases, okay, a more efficient way of acquiring investment assets. And the key is making sure the transaction is properly structured from the outset. I've been working on a growing number of share purchase transactions recently, helping investors secure funding while working alongside specialist solicitors, accountants, and tax advisors to ensure the structure is right from day one. So if you're looking at acquiring a property company, buying a portfolio, or simply want to understand whether a share purchase could work for your next deal, I'd be delighted to have a conversation. Feel free to get in touch.